If I were to talk about the Tax Cuts and Job Act of 2017, effective January 1st of 2018, there's many things that come to mind. The standard deduction becoming so large that most people who were able to itemize before can no longer do it again, or at least it doesn't behoove them to do so. We could talk about changes in the advisor deductions and tax reporting deductions, the loss of exemptions if you happen to have children. Many changes occurred right at the end of 2017, and you were given plenty of warning. Yeah, about a week, because they all went into impact January 1st of 2018. Understanding how quickly the tax code can change and the significant impact it can have on your life is hard to underestimate. Join us on Consider this program this week as we break down some of the things you need to know for sure, at least as we head into this following year. Well, good morning and welcome to Consider this program. I'm your host, Joe Clark.
And I'm Dean Huddleston.
Dean, we are happy to have you along. Dean is one of our senior advisors. He's up in the Lafayette office. Those of you who don't know, I grew up, or at least spent the last 2 years, and graduated from high school about 15 miles outside of West Lafayette, good old Benton Central, Indiana, the one school in the entire county and the largest county in Indiana. But we ended up having a very large office in Lafayette. I spent 7 years as an adjunct professor at Purdue University, where I taught financial planning, and a large part of this program is actually based on things that I learned while I was teaching at Purdue University. So very grateful and blessed to have had that opportunity. So Dean, we're going to talk about the Tax Cut and Jobs Act of 2017. Tell me what changes really stick out in your mind that people need to be aware of.
Well, the largest thing, Joe, is just the fact that the personal exemption changed, doubled in effect. And for most people who were used to taking off any medical expenses they've had, charitable donations, advisory fees, state and local taxes, real estate fee cost, mortgage interest, lots of that went away for millions of Americans because they couldn't have enough deductions to go over the standard deduction they were now going to receive. As a result of that, a lot of charities across the United States started thinking, gosh, if people can't deduct their taxes, their charitable donations from their taxes, we might see giving go down.
And did it?
It did.
Yeah, as I look at charities and churches, and you're a big part of your church and other not-for-profits in your community. As I look at our church and some of the things that happened, it really was the smaller donations. It wasn't people who were giving large chunks of change. It were smaller donations that those charities and churches depended upon.
Yes. That
really did go away. So let's just say this again: the largest single change for the average walking American, right?
Yep.
Was the change to the size of the standard deduction. The big three, as I talk about itemized deductions. Do you remember what the big three are?
Salt tax,
State and local taxes are the big one.
Yep. Charitable donations,
and
mortgage
interest. So people talk about if you have a mortgage, it's deductible. Well, it's only deductible on your taxes to the extent that you're able to itemize. If you take the standard deduction, paying mortgage interest doesn't help you. Same with state taxes, same with charitable donations. And that's what we saw happen with many people back in 2018 is those charitable deductions begin to go away. Obviously, that was continued through COVID, where
Yes.
some people didn't have the money, or you simply don't think about what you're not present in. When people weren't able to go to churches, that kind of stuff didn't happen. So tell me what the impact really was to churches and charities from this tax code change.
Well, it's a major impact. If you can't deduct those taxes, and churches, charitables, 501c3s, your local animal shelter, if they don't have that cash flow coming in, they are not going to be able to survive in the world we live in today. And finding a way for people to feel still comfortable about, I can give the amount I want, but I still want that bang for my buck. People still want to be able to say, I got to be as tax efficient as possibly can, and that's us. That's where we come in and help.
Now, there were two things that came out of that, though, that I think people need to be aware of. One is there's actually an above-the-line deduction that you can now take on your tax return. At the beginning, it was $300 per household. So remember, when we talk about the line on tax return, AGI, your adjusted gross income, is the quote unquote line, right? When you look at your AGI, anything that happens above the line is more impactful than anything that happens below the line. Above the line is a reduction of income. Below the line is a reduction of what you have to pay taxes on. And so the IRS said, okay, in order to get people to give again those smaller amounts, you could take a deduction of $300 on a 1040 if you made a deduction to a not-for-profit entity, even if you didn't take an itemized deduction. Starting in 2021, they actually doubled that. So you can now do a $600 above the line deduction. So if you think about that, if you were in the 22% bracket, for instance, you're saving about $444, right, to be able to take that above the line deduction and still do charitable things. So it's still an issue, and it's still out there, and you need to get the biggest bang you possibly can for your buck. So what are some options, Dean, for people still today to be tax efficient with their charitable deduction?
Well, first off, let's think about people who are taking the RMDs, required minimum distributions. You have to take that if you currently are at age 70 and a half. Now, we'll talk later about a rule that changed in the Secure Act that raised that amount. But if you're already taking an RMD, you can take the whole portion, part of it, and send it directly to your charity, and it doesn't hit your 1040. Now, again, I'm going to say it has to go directly to the charity. The money can't come to your bank account from your investment advisor, from whoever, and then you turn around and write a check. That money has to go out to the charity, and no reportable tax consequence to you on your 1040.
So I want to make sure we have our terminology squared away. What you said is accurate. So prior to what we're going to talk about actually in the next segment, your required minimum distribution for years, and required is that, right? You have to take the money out of the account. It's required. It's just a mere 50% penalty, the largest penalty in the tax code if you fail to comply. By the way, the penalty is what you should have taken out. So if you should have taken out $5,000, welcome to a $2,500 penalty, right? This is absurd, but that's the way the code is written. At 70 and a half, where the old required minimum distribution was elevated, and we're going to talk about that again, up to age 72, right? Up to age 72 is now when RMDs begin, effective 2020, even though because of COVID, you didn't have to take an RMD that year. Now at age 72, your distributions have to start. However, at 70 and a half, they left what's called the QCD, the Qualified Charitable Distribution alone. So you can still do that. As Dean said, it has to go directly to the institution. It can't pass through your hands and then go out, right? It has to go directly to the institution. It has to be for the general fund. It has to go to a 501c3. And kids my age, if you have parents who you believe are doing QCDs or Qualified Charitable Distributions, just a word to the wise, many custodians, Schwab, TD Ameritrade, Fidelity, Pershing, most of the big boys will not tell you on Form 1099 that you actually did a QCD. You have to inform your CPA. And if you forget, not only do you not get to use that as not having income on your return and giving it to a charity, but you're going to end up paying taxes on it, and you waste a very, very beautiful benefit. So even if you take the standard deduction, you can do a QCD. Right?
Yes, sir.
So talk to me about appreciated stock and how we would work with a family to, in this day and age, if they can't take a deduction, why would they still want to use appreciated stock in making a gift?
Well, anytime you have appreciated stock, it means just that. You have basis in that stock. And for our purposes, let's say today.
So now tell me what basis means.
Basis is the actual cost that you paid for that stock.
After tax is the key word. So not IRA money. You have no basis in an IRA.
Correct.
This is after that.
This is after tax. So you actually have, we'll say, $5,000 in a stock. You've owned it for a number of years, and that value has now increased to $10,000. You can if you were going to give a $5,000 donation to your church, you could have effectively go out and give that entire $10,000 worth of value of stock, give it to the church. They can accept it. We help churches all the time where 501c3s accept stock into an account. We don't charge them anything for it. We handle it as a courtesy. But you can effectively give them that stock and turn around and pay no capital gains on that $5,000 gain you had it in the value.
And that is a beautiful thing, and one of the things to be able to help mitigate in a portfolio. So one of the things that we do for families is help you step up your basis, right? So let's say the only stock that you own is Apple, and you love Apple, right? We have a high appreciation in Apple in terms of our portfolios. We bought it back in 2006 for the people who were there then that we take care of. And so a lot of times we gift Apple, and people will look at me and go, Joe, I don't want to gift my Apple. Well, I get that. I don't want to gift my Apple stock either. You know, I like the fruit company from Forrest Gump, right? and I use the phones and the technology. I get it, right? I don't want to do that either. However, I do want to step up my basis. For people that were around in 2006, your adjusted basis is less than $9 a share for that Apple stock. And today, you know, it's trading above 100. It's been much higher than where it is right now, but it's well above $115, $120 a share at the time of this recording. So if I were to sell it, I would have to pay capital gains on about $110, right? But I don't want to get rid of my Apple stock. Well, here's what's going to happen. We're going to transfer Apple stock out of an account to the charity. The charity's going to sell it. They get the full value. You pay no capital gains tax, and you take the check that you were going to use to make to write to the church or the charity, and you're going to put that money in your own investment account, and we're going to buy more Apple. So nothing changed other than you getting a step up in basis and what's going on. And folks, this is the difference between doing tax planning, something that happens proactively before a transaction occurs, and waiting and trying to explain to your CPA, well, duh, I could have had a V8. I should have done that. Well, yes, you should have, but you got to think about this ahead of time. And that's where the Financial Enhancement Group comes into play. Again, if you want to do this on your own, that is your business. But if you're looking for a fiduciary, that is our business. Give us a call at 800-928-4001 or go to yourlifeafterwork.com and get signed up for a Next Steps meeting. It's complimentary, and Dean and the rest of our advisory team look forward to meeting you. 800-928-4001, yourlifeafterwork.com.